Question 1. An investor purchases one ABC Jan 50 call at 3. At expiration, ABC stock is trading at 54. What is the investor's profit or loss? A. $100 profit. B. $300 loss. C. $400 profit. D. $700 profit. Answer. A. $100 profit. To calculate the profit or loss on a long call, first determine the break-even point, which is the strike price plus the premium paid. 50 plus 3 is equal to 53. Since the stock expires at 54, which is above the break-even point, the investor profits. The profit is calculated as the market price at expiration minus the break-even point, 54. 53 is equal to 1 point profit. Since each point represents $100, the total profit is $100. This demonstrates understanding of basic options profitability calculations for a long call position. Question 2. Which of the following statements is true regarding general obligation? Go bonds? A. They are typically secured by specific user fees or tolls. B. Voter approval is usually required for their issuance. C. They are always exempt from state income tax, regardless of investor residency. D. They are considered self-supporting debt. Answer. B. Voter approval is usually required for their issuance. General obligation, GO, bonds are backed by the full faith and credit and taxing power of the issuer, typically a state or local government. Due to their reliance on general tax revenues and the impact on a municipality's debt limit, voter approval is usually required before GO bonds can be issued. This distinguishes them from revenue bonds, which are self-supporting and backed by specific revenue streams and do not typically require voter approval. Option C is incorrect because state income tax exemption for municipal bonds typically only applies to residents of the issuing state, not universally, and not all GO bonds offer local tax exemption. Question 3. An investor opens a joint tenants with right of survivorship, STROs, account with their spouse. If one spouse dies, what happens to the assets in the account? A. The assets are frozen and distributed according to the deceased's will. B. The deceased share passes to their estate, subject to probate. C. The surviving spouse automatically becomes the sole owner of all assets. D. The account is converted to a tenants in common account. Answer. C. The surviving spouse automatically becomes the sole owner of all assets. In a joint tenants with right of survivorship, STRO's account, if one account holder dies, their interest in the account automatically passes to the surviving account holder, S, without going through probate. This right of survivorship is a key characteristic that distinguishes it from a tenants in common account, where the deceased share would pass to their estate. This structure is common for married couples due to its ease of transfer upon death. Understanding the implications of different joint account ownership structures is essential for customer account knowledge. Question 4. On what date does the FINRA establish the ex-dividend date for common stock? A. 2 business days before the record date. B. 1 business day after the record date. C. The same day as the record date. D. 3 business days before the record date. Answer. A. 2 business days before the record date. The ex-dividend date is the first day a stock trades without the value of the next dividend payment. For regular way settlement, FINRA, or the exchanges for listed securities, sets the ex-dividend date 2 business days before the record date. To receive the dividend, an investor must purchase the stock before the ex-dividend date. This crucial date impacts who receives the dividend and helps maintain orderly trading around dividend payments. Question 5. A mutual fund that charges a sales charge when shares are redeemed is known as A. Class A share fund. B. Class B share fund. C. Class C share fund. D. No-load fund. Answer. B. Class B share fund. A mutual fund that charges a sales charge upon redemption is known as a Class B share fund, which typically features a contingent deferred sales charge. See disque. This sales charge decreases over time and eventually disappears if the investor holds the shares long enough. In contrast, Class A shares have a front-end load, and Class C shares have a level load with a small back-end load that disappears quickly. Understanding the different mutual fund share classes and their associated sales charges is vital for recommending suitable investments to clients. Question 6. A bond trading at a discount will have its yield to maturity, YTM, its current yield, CY. A. Equal to. B. Higher than. C. Lower than. D. Unrelated to. Answer. B. Higher than. When a bond trades at a discount, its yield to maturity, YTM, will be higher than its current yield, CY. This is because the YTM considers not only the annual interest payments, which determine the current yield, but also the capital gain that will be realized if the bond is held to maturity and matures at par. Conversely, for a bond trading at a premium, YTM would be lower than CY. Grasping the relationship between different bond yields and bond prices is fundamental for understanding fixed income investments. Question 7. Which of the following best describes the primary market? A. Where previously issued securities are traded between investors. B. The market where new issues of securities are sold to the public for the first time. C. A market for trading derivatives like options and futures. D. The market for short-term debt instruments. Answer. B. The market where new issues of securities are sold to the public for the first time. The primary market is where issuers, such as corporations or governments, raise capital by selling new securities to the public for the very first time. This includes initial public offerings, IPOs, and subsequent primary offerings, SPOs. Once these securities are initially sold, they then trade in the secondary market. Distinguishing between the primary and secondary markets is a foundational concept in understanding capital markets and how companies raise money. Question 8. According to Regulation T, what is the initial margin requirement for purchasing common stock? A. 25% of the purchase price. B. 30% of the purchase price. C. 50% of the purchase price. D. 100% of the purchase price. Answer. C. 50% of the purchase price. Regulation T, set by the Federal Reserve Board, dictates the initial margin requirement for purchasing common stock in a margin account, which is currently 50% of the purchase price. This means an investor must deposit at least 50% of the value of the securities, with the remaining balance borrowed from the brokerage firm. While FINRA and individual firms may set higher minimums, Regulation T establishes the baseline requirement. Understanding margin rules is critical for clients utilizing leverage in their investment strategies. Question 9. An investor owns 100 shares of ABC stock, purchased at $60 per share, and buys one ABC put 60 at 4. What is the break-even point for this protective put strategy? A. 56. B. 60. C. 64. D. 50. Answer. C. 64. A protective put strategy involves buying a put option on a stock that an investor already owns. The overall break-even is calculated as the cost of the stock, plus the premium paid for the put. In this case, the stock was purchased at $60, and the put premium was $4. Therefore, the break-even for the combined position is $60, stock cost, plus $4, put premium, equals $64. This represents the point where the stock must be trading for the investor to recoup their total outlay, including the cost of the protection. Understanding this strategy is key to managing risk for stock positions. Question 10. A New York resident invests in a general obligation bond issued by the City of New York. This bond's interest payments are generally exempt from A. Federal income tax only. B. State income tax only. C. Local income tax only. D. Federal, state, and local income tax. Answer: D. Federal, state, and local income tax. Interest income from municipal bonds is generally exempt from federal income tax. Additionally, if the bond is issued by a municipality within the investor's state of residence, the interest is typically exempt from state and local income taxes as well, making it triple tax exempt. This tax advantage is a primary reason investors choose municipal bonds. The specific tax treatment is a crucial element when evaluating the suitability of municipal bonds for a client. Question 11. A suspicious activity report, SCR, must be filed with FINRA within how many days of the discovery of suspicious activity? A. 10 calendar days. B. 15 calendar days. C. 30 calendar days. D. 60 calendar days. Answer: C. 30 calendar days. Financial institutions, including broker-dealers, are required to file a Suspicious Activity Report, SCR, with the Financial Crimes Enforcement Network, FINRA, within 30 calendar days of becoming aware of suspicious activity. This is a critical component of anti-money laundering, AML regulations, designed to detect and deter illicit financial transactions. SARs are kept confidential, and the firm cannot disclose to the client that a report has been filed. Adhering to these strict timelines is crucial for compliance and combating financial crime. Question 12. Which of the following is required for a registered representative to exercise discretion in a customer's account? A. Verbal permission from the customer for each trade. B. Written power of attorney from the customer. C. The customer's notarized signature on a trading authorization form. D. A letter of authorization from the customer, without necessarily being written. Answer: B. Written power of attorney from the customer. To exercise discretion in a customer's account, a registered representative must obtain written authorization from the customer, typically in the form of a written power of attorney. This authorization allows the representative to make investment decisions, such as what security to buy or sell, how much, and when, without seeking prior approval for each individual trade. Without this written authorization, each order must be approved by the customer. Understanding discretionary authority is essential for protecting both the firm and the customer. Question 13. American Depository Receipts, ADRs, facilitate: A. Direct ownership of foreign company shares by U.S. investors. B. The trading of foreign company shares in U.S. markets. C. U.S. investors investing in municipal bonds. D. The conversion of U.S. dollars into foreign currency. Answer: B. The trading of foreign company shares in U.S. markets. American Depository Receipts, ADRs, are certificates issued by a U.S. bank that represent a specified number of shares of a foreign stock. They allow U.S. investors to trade shares of foreign companies on U.S. exchanges, bypassing the complexities of direct foreign market transactions. ADRs are denominated in U.S. dollars and are subject to U.S. securities laws, making it easier and more convenient for domestic investors to participate in international markets. This mechanism is crucial for expanding investment opportunities globally. Question 14. Which of the following investment vehicles trades on an exchange throughout the day like a stock? A. Open-end mutual fund. B. Unit investment trust, UIT. C. Exchange-traded fund, ETF. D. Variable annuity separate account. Answer: C. Exchange-traded fund, ETF. An exchange-traded fund, ETF, is an investment fund that holds assets like stocks, commodities, or bonds, and trades on stock exchanges throughout the day, much like a regular stock. Unlike open-end mutual funds, which are priced once at the end of the trading day, NAV. ETFs can be bought and sold at their market price anytime the market is open. This intraday trading flexibility is a key differentiator for ETFs. Understanding this feature is important when considering liquidity and trading strategies for different pooled investment vehicles. Question 15. Which of the following statements is true regarding zero-coupon bonds? A. They pay interest semi-annually and mature at a premium. B. They are bought at a discount and mature at par, with the interest being the difference. C. They have stable prices and are suitable for income-seeking investors. D. They are exempt from federal income tax. Answer. B. They are bought at a discount and mature at par, with the interest being the difference. Zero-coupon bonds do not pay periodic interest payments. Instead, they are purchased at a discount to their par value and mature at par, with investors' return coming from the accretion of the discount. While they don't pay cash interest, the imputed interest, the annual accretion of the discount, is still taxable each year, even though no cash is received, a concept known as phantom income. These bonds are highly sensitive to interest rate changes and are often used for specific future financial goals. Understanding their unique structure and tax implications is crucial. Question 16. In a firm commitment underwriting, the syndicate acts as A. An agent, selling securities on a best efforts basis. B. A principal, purchasing the entire issue from the issuer. C. An advisor, assisting the issuer with pricing the securities. D. A market maker, facilitating secondary market trading. Answer. B. A principal, purchasing the entire issue from the issuer. In a firm commitment underwriting, the syndicate, underwriters, acts as a principal, agreeing to purchase the entire issue of securities from the issuer and then reselling them to the public. This means the syndicate takes on the risk of any unsold shares. This type of underwriting provides the greatest assurance to the issuer that the entire offering will be sold and capital will be raised. Understanding the role of the underwriter in a firm commitment is central to primary market operations. Question 17. An investor owns 100 shares of XYZ stock, currently trading at $50. They sell one XYZ Jan 50 call at 3. What is the maximum profit for this covered call strategy? A. $300. B. $500. C. $5,000. D. Unlimited. Answer. A. $300. In a covered call strategy, an investor sells a call option against shares of stock they already own. The maximum profit for this strategy is limited to the premium received from selling the call option. In this case, the investor received $3 per share, or $300 for 100 shares, for selling the call. This strategy generates income, but caps the upside potential of the stock. Understanding the profit limitations is key for investors using covered calls to enhance yield or reduce cost basis. Question 18. Which of the following would not be included in the calculation of net direct debt for a municipality? A. General obligation bonds. B. Revenue bonds. C. Overlapping debt. D. Short-term anticipation notes. Answer. B. Revenue bonds. Net direct debt is a municipality's debt for which it is solely responsible, primarily general obligation, GO bonds, and short-term debt instruments like anticipation notes. Revenue bonds are generally excluded from net direct debt calculations because they are self-supporting, paid from specific project revenues rather than general tax receipts. Overlapping debt, while a factor in overall municipal credit analysis, is debt shared with other entities and not solely direct to the municipality in question. Differentiating between types of municipal debt is critical for credit analysis. Question 19. An individual uses material, non-public information obtained through their employment to trade securities for personal profit. This action is considered A. Market manipulation. B. Front running. C. Insider trading. D. Churning. Answer. C. Insider trading. Using material, non-public information to trade securities for personal profit, or to tip others who then trade, is illegal insider trading. This practice is prohibited by federal securities laws and can result in severe civil and criminal penalties. The information must be material, likely to affect the stock price, and non-public, not generally available to the public. Preventing insider trading is a core tenet of maintaining fair and efficient capital markets and protecting investors. Understanding and avoiding insider trading is paramount for all financial professionals. Question 20. A transfer on death, TOD, designation on an individual brokerage account allows A. The account assets to be transferred to a trust upon the owner's death. B. The account assets to bypass probate and go directly to named beneficiaries. C. A guardian to manage the account if the owner becomes incapacitated. D. The account to be managed by an executor until a will is probated. Answer. B. The account assets to bypass probate and go directly to named beneficiaries. A transfer on death, TOD designation allows an individual account holder to name one or more beneficiaries to receive the assets in the account directly upon the owner's death, bypassing the probate process. While a will dictates how assets are distributed through probate, a TOD designation supersedes the will for the assets in that specific account. This provides a simpler and often quicker transfer of assets to beneficiaries. Understanding TOD is important for estate planning and ensuring clients' wishes are met efficiently. Question 21. Which feature of preferred stock allows shareholders to receive any skipped dividends before common shareholders are paid? A. Callable. B. Convertible. C. Cumulative. D. Participating. Answer. C. Cumulative. Cumulative preferred stock is a type of preferred stock where any missed dividend payments must be paid to cumulative preferred shareholders before any dividends can be paid to common shareholders. If the company skips a dividend payment, those arrearages accumulate and must be settled. Non-cumulative preferred stock does not have this feature, meaning skipped dividends are lost forever. Understanding the cumulative feature is crucial for investors prioritizing income stability and dividend protection. Question 22. Which of the following investment companies has a fixed portfolio of securities and typically terminates on a specified date? A. Open-end mutual fund D. B. Exchange-traded fund ETF. C. Unit investment trust UIT. D. Closed-end fund. Answer. C. Unit investment trust UIT. A unit investment trust UIT is an investment company that has a fixed portfolio of securities, meaning the portfolio is generally not actively managed. UITs typically have a specified termination date, at which point the portfolio is liquidated, and the proceeds are distributed to unit holders. They issue redeemable units, similar to mutual funds, but do not actively trade their portfolios. This contrasts with mutual funds, ETFs, and closed-end funds, which typically have actively managed or at least adjustable portfolios. Understanding UITs is important for recognizing their distinct structure and purpose in investment portfolios. Question 23. A key risk associated with mortgage-backed securities, MBS, is A. Market risk. B. Interest rate risk. C. Prepayment risk. D. Call risk. Answer. C. Prepayment risk. Prepayment risk is a significant concern for investors in mortgage-backed securities, MBS. This risk arises when interest rates decline, prompting homeowners to refinance their mortgages at lower rates, which effectively returns principal to MBS investors sooner than expected. While other risks like interest rate risk, market risk, are also relevant. Prepayment risk is particularly prominent and unique to MBS. Understanding prepayment risk is crucial for assessing the suitability and potential returns of these complex securities. Question 24. An investor holds a margin account with $10,000 in equity and a market value of $20,000. If the maintenance margin requirement is 25%, by how much can the market value of the securities decline before a maintenance call is issued? A. $2,000. B. $5,000. C. $6,667. D. $10,000. Answer. C. $6,667. A maintenance margin call is issued when the equity in a margin account falls below the maintenance margin requirement. The formula for the maintenance margin call point is debit balance / 1 maintenance margin percentage. In this case, the debit balance is market value. Equity equals $20,000 to $10,000 equals $10,000. So $10,000 / 10 25 equals $10,000 / 0. 75 equals $13,333, 333. This means a call is triggered if the market value drops below $13,333, 33. The securities can decline by $20,000 to $13,333. 33 equals $6,666, 67 before a call is issued. To provide the most precise integer option, $6,667 is the correct choice. Understanding margin call calculations is essential for managing risk in leveraged accounts. Question 25. Relative to the current market price of the underlying stock, an option is considered in the money if it has intrinsic value. Given this, a put option with a strike price above the current market price and a call option with a strike price below the current market price would both be considered. A. In the money. B. Out of the money. C. At the money. D. Near the money. Answer. A. In the money. An option is considered in the money if it has intrinsic value. For a put option, this occurs when the strike price is above the current market price of the underlying stock. For a call option, this occurs when the strike price is below the current market price of the underlying stock. Both scenarios represent options that have immediate value if exercised. Understanding the in the money, out of the money, and at the money concepts is foundational for options trading. Question 26. Which of the following describes the purpose of an official statement for a new municipal bond issue? A. To act as a prospectus for equity securities. B. To provide material information about the bond issue and the issuer to potential investors. C. To certify the bond's tax-exempt status. D. To guarantee the bond's interest payments. Answer. B. To provide material information about the bond issue and the issuer to potential investors. The official statement, OS, for a new municipal bond issue is the primary disclosure document provided to potential investors. It contains comprehensive material information about the bond issue, the issuer's financial condition, and relevant economic and legal factors. While similar in purpose to a corporate prospectus, it is specifically for municipal bonds and is not reviewed by the SEC. Providing transparency to investors is crucial for the municipal bond market, and the OS fulfills this role. Understanding the OS is key for due diligence in municipal bond investing. Question 27. A registered representative assists a friend in selling a privately held company's shares to other investors for a commission, without the knowledge or approval of their employing broker-dealer. This activity is best described as A. Selling away. B. Churning. C. Market manipulation. D. Free riding. Answer. A. Selling away. Selling away occurs when a registered representative sells securities that are not offered by their employing broker-dealer, without the firm's knowledge and approval. This is a serious violation of FINRA rules, as it bypasses the firm's supervisory responsibilities and exposes investors to unvetted products. Firms must approve all outside business activities and private securities transactions. Understanding and avoiding selling away is paramount for registered representatives to maintain compliance and protect both their license and the investing public. Question 28. An account opened for a minor under the Uniform Gifts to Minors Act, UGMA, or Uniform Transfers to Minors Act, UTMA, has which of the following characteristics? A. The minor can withdraw funds at any age with parental consent. B. The minor is the beneficial owner, but an adult custodian manages the account. C. The account is joint with right of survivorship between the minor and the custodian. D. The custodian has unrestricted discretionary trading authority in the account. Answer. B. The minor is the beneficial owner, but an adult custodian manages the account. Under UGMA/UTMA accounts, the minor is the beneficial owner of the assets, but an adult custodian retains control and manages the account until the minor reaches the age of majority, typically 18 or 21, depending on the state. The custodian has a fiduciary duty to manage the assets in the best interest of the minor. These accounts are generally single beneficiary and single custodian, and the minor cannot access the funds until reaching the age of majority. Understanding the structure and rules of custodial accounts is vital for managing investments for minors. Question 29. Which of the following would result in an increase in the number of shares outstanding and a decrease in the stock's market price per share, but with no change to the aggregate market value of the outstanding shares? A. Stock split. B. Reverse stock split. C. Stock buyback. D. Cash dividend. Answer. A. Stock split. A stock split increases the number of shares outstanding and proportionally decreases the market price per share, while the total market value of an investor's holding remains unchanged. For example, a 2-for-1 split doubles the shares and halves the price. This action is typically done to make the stock more accessible to a wider range of investors by lowering its per share price. In contrast, a reverse stock split does the opposite, consolidating shares and increasing the price per share. Understanding the mechanics of stock splits is important for tracking an investor's equity holdings. Question 30. Which characteristic is not typically associated with hedge funds? A. Limited liquidity with high minimum investment requirements. B. Use of sophisticated investment strategies and leverage. C. High degree of regulation by the SEC and other bodies. D. Fees structured as 2 and 20. 2% management fee, 20% performance fee. Answer C. High degree of regulation by the SEC and other bodies. Hedge funds are generally characterized by a lower degree of regulation compared to traditional investment companies, like mutual funds. They are typically structured as private investment partnerships, allowing them to employ more aggressive strategies, leverage, and short selling. This lighter regulatory oversight is often why they are only available to accredited investors. Understanding the distinct characteristics of hedge funds, including their limited liquidity and fee structures, is important for distinguishing them from other investment vehicles. Their limited regulation allows for greater investment flexibility, but also implies higher risk. Question 31. Which of the following U.S. Treasury securities is issued at a discount and does not pay periodic interest? A. Treasury bonds. B. Treasury notes. C. Treasury bills. D. TIPS. Treasury inflation-protected securities. Answer. C. Treasury bills. Treasury bills, T-bills, are short-term U.S. government securities with maturities of 1 year or less. They are issued at a discount to their face value and do not pay periodic interest. The investor's return comes from the difference between the purchase price and the face value received at maturity. T-bills are considered virtually risk-free due to their U.S. government backing and short duration. This distinguishes them from Treasury notes and bonds, which are longer-term and pay semi-annual interest. Understanding the characteristics of different Treasury securities is fundamental for fixed-income investing. Question 32. What is the primary role of a market maker in the NASDAQ market? A. To execute buy and sell orders on behalf of clients. B. To provide liquidity by standing ready to buy and sell a particular security. C. To originate and underwrite new issues of securities. D. To oversee the compliance of broker-dealers. Answer. B. To provide liquidity by standing ready to buy and sell a particular security. The primary role of a market maker in the NASDAQ market and other over-the-counter markets is to provide liquidity by continuously quoting both a bid price, at which they are willing to buy, and an ask price, at which they are willing to sell for a particular security. By doing so, they facilitate trading and ensure there is always a party willing to take the other side of a trade, contributing to market efficiency. This differs from a broker who executes orders on behalf of clients. Understanding the function of market makers is crucial for comprehending how secondary markets operate. Question 33. An investor sells one ABC February 50 put at 4. What is the maximum potential loss for this position? A. $400. B. $4,600. C. $5,000. D. Unlimited. Answer. B. $4,600. Selling a put option obligates the seller to buy the underlying stock at the strike price if the option is exercised by the buyer. The maximum potential loss for a short put is significant and occurs if the stock price drops to zero. It is calculated as the strike price minus the premium received, multiplied by 100 shares. In this case, $50 strike, $4 premium, asterisk 100 shares equals $4,600. This substantial potential loss is why short put positions are considered risky and typically require margin. Understanding the risk profile of short options positions is vital for options traders. Question 34. Which type of annuity provides a guaranteed income stream for life, but payments do not begin until a future date? A. Immediate variable annuity. B. Deferred variable annuity. C. Immediate fixed annuity. D. Deferred fixed annuity. Answer. D. Deferred fixed annuity. A deferred fixed annuity provides a guaranteed income stream, meaning the payments are fixed and predictable. The deferred aspect indicates that the income payments will begin at some point in the future, not immediately upon purchase. This contrasts with an immediate annuity, where payments begin soon after purchase, and variable annuities, where payments fluctuate based on the performance of underlying investments. Understanding the characteristics of different annuity types is important for retirement planning. Question 35. A registered representative engages in excessive trading in a customer's account to generate commissions, without any real benefit to the customer. This unethical practice is known as A. Front running. B. Painting the tape. C. Churning. D. Matched orders. Answer. C. Churning. Churning is an unethical and illegal practice where a registered representative engages in excessive trading in a customer's account primarily to generate commissions, without considering the customer's investment objectives. This practice violates FINRA rules regarding suitability and fair dealing. It is distinct from other market manipulation tactics as it focuses on abuse within a client relationship, rather than influencing market prices generally. Recognizing and reporting churning is crucial for protecting investors and upholding ethical standards in the securities industry.